Good morning, everyone. Thank you so much for joining us today. I'm Zoya Claus, chair of the Charlottesville Young Professional Network, or YPN, and I welcome you to our April Latte and Learn. This session is focused on 1031 exchanges. Our guest speaker is John King. John is currently employed by First American Exchange Company, a 1031 qualified intermediary, and is licensed to practice law in both Florida and California. It's essential that we thank our sponsors for this year-long support as we deliver education and networking opportunities. I want to thank our title sponsors, Charlottesville Moving Company, Fulton Mortgage Company, and Greenwood Homes. I would also like to thank our event sponsor, Farm Credit of the Virginias, for their continued YPN support. And next, I would like to mention that today's charity is Shelter for Help in Emergency. I am pleased to welcome Claire O'Reilly to provide more information about this wonderful organization.
Hi guys, I'm Claire O'Reilly. I'm with the Shelter for Help in Emergency. If you guys haven't heard of us, we are the area's domestic violence agency. So we provide services to Charlottesville and Albemarle and also some of the surrounding counties. We have a lot of different services. I'm not gonna run through everything. It's just like a quick hello to give you guys some more information. But the primary services that we provide are our hotline, which is 24 hours every day of the week. So anytime somebody might need help, talk to an advocate, whatever it might be, they can call us. That is everywhere on our hotline cards, on our pamphlets, on our websites. You'll find them in bathrooms. We try to keep them as available as possible. And we have a confidential residential facility, so anyone that calls us and needs to stay with us for safety can come and stay with us for up to 8 weeks, and it's totally confidential. All of our services are completely free. We also offer legal advocacy as well, which means that if someone is filing for custody, whatever it might be, protective orders, we can provide that legal advocacy. It's not legal advice. We don't have lawyers on staff for that kind of stuff. We work with community members, but our legal advocates can kind of provide that information and be a friendly face. And yeah, and I do a lot of these kinds of things to connect with the community, and we really appreciate the support you guys are giving us this month. It means a lot.
Thank you so much, Claire, and it's very nice to meet you. Thank you for being here with us today. Please donate any amount through our GoFundMe link, which Kelly shared in the chat, or you can scan the QR code on the screen. Regardless of how much you donate, you will be entered to win a lottery to win a great prize. The winner will be notified on Monday, April 14th via email. New as of last year, we divide our end of year registration income and donate it to the local charities that we are supporting. John King, I will now hand over the session to you.
Thank you. I am going to share my screen. And hopefully you can all now see the slides. Yep, thanks. I appreciate the invite to talk about 1031. This will be a pretty quick overview of kind of the basics of what you might experience or encounter when trying to get started. There's a lot more to 1031 than we'll talk about this morning. What I hope you'll take away from the presentation is that if you need anything related to the topic, you want to speak with me directly, or you have a customer that wants to speak with me, or the customer's other tax or legal professionals want to speak with us about anything 1031 related, how they can navigate the process, etc., feel free to reach out. One of the luxuries of our service, I think, is that we will talk to anyone about a transaction and it doesn't cost them anything. We hope that by providing good guidance and suggestions and the like, that will be chosen to provide the service when it's needed. But until that point, we're happy to talk about the process with anybody who's interested. So what is a 1031 exchange? It's really just a regulation of the tax code that allows people to defer paying capital gains taxes when they dispose of investment real estate or trade or business use real estate that would be subject to capital gains if there was an election to just cash out of the investment. You're disposing of and acquiring like-kind properties, and you need to follow some fairly restrictive rules when you're navigating the process. We're going to touch on all of these bullet points in more detail as we progress. So hopefully I'll explain all of the subject topics as we go. So what are capital gains? That's the taxable income that is generated when you sell an asset for more than its adjusted basis. What's adjusted basis? It's typically determined by taking the original price of the asset that was purchased, adding to that any improvements that are made to it, and then subtracting from that any depreciation that has been taken. That adjusted basis number is very important for many reasons. If you're paying tax, obviously you want to know what that is because you get to keep the adjusted basis. You're not taxed on that. And then when you're trying to figure out how much gain might I be subject to in a particular transaction, we want to know that as well to help figure out what the potential tax bill might be. So here's an example. And when I'm using these numbers, I'm just using round numbers. Typically when you're selling something, you're going to have some closing costs. So that's going to reduce your actual sales price down to a net sales price. But I'm going to use round numbers just for convenience. So let's say I have an asset that I'm going to sell for $1 million. My adjusted basis in it is 300. That means I have potential gain that's potentially taxable of $700,000. So most of the time when I'm talking to people about 1031, they're intending to stay invested in real estate. So it's important for them to know what they would be paying in the way of taxes if they decided just to cash out and move on net of the taxes versus how much extra money might I have available if I use this deferral tool to reinvest into my next property. And that's why we go through this kind of checklist with people when they call and we're trying to figure out, does 1031 make sense or does it not? So you see here again, my numbers: $1 million sale price, 300,000 basis, gain is 700,000. Then what you need to do, or the customer needs to do, is an analysis of, okay, I'm going to have all this gain. What does that mean to me from a tax standpoint? And so there are many levels of taxation that take place when you dispose of something that's investment real estate or trade or business use property. So from a federal perspective, we have federal capital gains, and capital gains are generally less than ordinary income depending on your hold time. So if you own and hold something for less than a year, that's short-term capital gain, which is really just ordinary income. If you own something and hold for a year and a day, that shifts you to long-term capital gains, which is a more preferable rate. And so you'll see here in parentheses a 15% or 20% rate. There's actually 3 capital gains rates: 0, 15, and 20, and it's all based on income. So for the most part, when I'm dealing with people, they're either in the 15 or 20% rate. And so if you're single and you earn between $48,351 and $533,400, you're in the 15% bracket. If you're married, filing jointly, and you earn between $96,701 and $600,051, sorry, you're in the 15% bracket. If you have earnings above those numbers, so earnings above $533,400 as an individual and earnings above $600,051 as a married couple, then you get bumped to the 20% rate. I would say most of the customers I deal with are in the 15% bracket. I do have some institutional customers I work with that are in that 20% range, but for the most part, about 60% of our business is probably what I would refer to as residential investment 1031 exchanges, and most of the people fall in that 15% federal tax break capital gains rate. Now, I deal with people all over the country, and some states have income tax and some states don't. If you are in a state that does have state income tax, the state is also going to want some capital gains from you when you decide to cash out and sell. Another one that can come into play is this Medicare tax, or also called net investment income tax. If you're a single person and you own or earn more than 200,000, a married couple earning more than 250,000, you also have this additional 3.8% tax that would be due. And then the bottom there, you see depreciation recapture. If you're taking depreciation against your property, the IRS is going to want 25% of what you took back. So this recapture rate. And so in this example, without doing the actual calculations, I would estimate, if you decided to sell this asset that had $700,000 worth of gain and you just wanted to pay the tax, you'd pay somewhere between $131,600 and $193,200 in taxes for being successful in your investment. And if you're okay with that and you just want to pay and be done with the IRS, that's great. You'll just do so. But if you're staying in the real estate market, there's no reason to have the net number less this tax that's due to reinvest. Why not take advantage of the full amount? And that's exactly what 1031 allows you to do, because it helps you to avoid paying any of these aforementioned taxes. And in most states that follow the federal guidance, which now I think it's all 50. Pennsylvania used to be a holdout, but no longer. If you get deferral from the federal level, you'll also get deferral at the state level. Oftentimes there's just an extra set of forms that you have to submit to the taxing authority, but it's pretty consistent now across the country, which is a great thing. So what are the requirements? We know what the implications are. What are some of the requirements? Here's some kind of common definitions that I think will be helpful for you if you're investigating this on your own, or if you're talking with someone like me when we're using terms of art, just so you have a kind of initial understanding of what we're talking about. So in our previous slide, we mentioned you're always exchanging something for something else. So what you're getting rid of is what we refer to as the relinquished property, or the to be sold property. What you're acquiring is called the replacement property, or to be acquired property. The qualified intermediary is what the company I work for does. We're going to help create this exchange process. And then there's another one that gets floated around all the time called boot. I really dislike that we have it in our vernacular, but it's there. And all it really means is when you sell something, you receive boot. When you buy something, you pay boot. And the whole idea is you want them to completely offset, so there's no quote unquote boot receipt remaining that could potentially cause the transaction to be partially taxable. So what are we talking about here? It's got to be an exchange, meaning you've got to have the process set up correctly. And I'll explain a little bit more what you need to do in just a moment. And then we're exchanging like-kind property that's used for investment purposes or in a trade or business for other property that's going to be used or held for the same purpose. We've got a pretty strict timeline. I'll show you more detail on that as well, but it's essentially a 180-day window broken into two parts. You have to identify within the first 45, and then you've got to close by day 180. And there's a value proposition where you've got to look for equal or greater in value and equity, and then some same taxpayer requirements in order to fulfill the obligation to make sure the taxpayer that's responsible for the tax is actually doing the transaction and not mistakenly being done otherwise. And that'll be a little more clear when we get to that slide. So how do you create an exchange? If you're in the real estate business of buying and selling, just think of an ordinary transaction. You're going to list something for sale. It's going to get put under contract. There's going to be a closing scheduled to take place. And same thing on the acquisition side. You'll find property, put it under contract, and schedule a closing. In order to create the exchange, what you want to do prior to closing of the sale piece is you want to connect with a qualified intermediary. That qualified intermediary will talk through the issues that we're discussing now, make sure it makes sense for the party to do a 1031 exchange, and then we will create the process for the customer. What does that mean? We're going to prepare what's called an exchange agreement, which is the contract between us and the taxpayer. We're going to prepare an assignment, which allows us to interject ourselves into the middle of the transaction and instruct the settlement agents how to manage their file and where to wire funds. And then we're going to do a notice to the other side, meaning the buyer if we're doing the sale side of the transaction, and the seller if we're doing the buy side. So we're going to create what's required by the regulation to distinguish this between a transaction that would just be a sale followed by a purchase, because we're trying to create what we call a reciprocal exchange. So that's one of the main functions we perform, is preparing all of that documentation. And then another main one we perform is we hold funds. The taxpayer cannot control the exchange proceeds or net sales proceeds during the process, meaning they can't actually have possession of them, nor can anybody that's their agent have control of them. That's why in most instances you need what we call a neutral qualified intermediary to manage the process for the customer. In our world, what we typically do is, even though I'm depositing the funds on behalf of the client or taxpayer as required by the regulation, what I do is get my customer to fill out a W-9. I take that W-9 and the funds and bring them to the bank, in which case the bank will then open up a segregated, separate bank account for each transaction that I open, which does a couple of things. It keeps everything from being commingled. And because it's not commingled and held separately and attached to the taxpayer's W-9, that gives the taxpayer bankruptcy remoteness protection from us. And so that's a great level of protection for them, because bankruptcies happen all the time and the like. And instead of their money, which is really not my money, even though I'm controlling it, instead of it being tied up in a bankruptcy estate, it remains the property of the as far as the IRS is concerned. Anything that's from a trade or business is generally going to be considered like kind to any other property that's held for the same purpose. So some of these examples you see here, single family house for raw land, that's going to be like kind for 1031. An apartment building for a retail center, an office building for a warehouse, a fourplex for a TIC, which is called tenant in common, which is an undivided interest in an office building. That's going to be fine as well. So it's a very broad application of what like kind means for 1031 purposes. In other sections of the tax code, like kind is very restrictive, but in our definition, it's very broad. So if virtually anything you can think of that's real estate is going to qualify. There are some things that don't, though. So for example, your personal or primary residence is not going to be like kind to an investment property or trade or business property that you dispose of. Primary residences have their own exclusion under the tax code. It's called Section 121. Sometimes that's great. Sometimes it's not, depending on the appreciation of the asset. Section 1031 can work together, kind of beyond the scope of our conversation this morning, but do know that if there's ever any questions about that, you could, give somebody like me a call or shoot them an email, and they should be able to provide you some information about how those two things can work together. Vacation homes. If you're using something primarily for vacation, which I would call personal use, that's not going to generally be called investment or trade or business use property, just because the personal use is excessive. Now, there are situations where you can have some vacation use or personal use and still classify something as investment. Again, beyond the scope of our conversation this morning, but if you talk to someone like me, we should be able to help define that for a customer. Property that's held for sale, the people that like to buy, fix, and flip in the short term, they're generally called dealers of real estate, and are not supposed to be using 1031 to defer, because it's property that's held for sale, not for investment. And then, ordinary home builders and the like, they're typically holding stuff in inventory, not for investment, and therefore they shouldn't be doing 1031 either. Dual purpose properties, what I mean by that is I see a lot of people trying to carve out like home offices and take depreciation deductions and the like for them. Is that technically investment? It probably is for the office, but it's really hard then to go exchange into something new that fits that home office criteria, right? So generally, when you have little things like that going on, it's going to be problematic from a 1031 standpoint. However, if you think of other uses, like let's say a duplex, I live in one unit, I rent one unit out. You're going to be able to do an exchange on something like that because you can clearly delineate my primary use property from my investment property. And so you could be able to take advantage of 1031 in situations like that. And then generally speaking, stocks and bonds and partnership interests, you know, items that you own that are representative of your ownership in an entity, for example, those are typically not considered real estate for tax purposes and therefore not exchangeable under Section 31. So if we move on now to the kind of some of the more important parts of the process, the time frame is what's really going to be scrutinized by the Internal Revenue Service. So again, I mentioned we have this broad 180-day window in which to complete a 1031 exchange transaction. And it starts on the day of the closing of the relinquished property. We call that day zero. Your 45-day identification window begins to run the next day, day one. So you have that 45 days to identify replacement property. I'm going to tell you a little bit about how you go about doing that on the next slide. Then you have the balance of the 180-day window, the finishing time, to actually close on something that you identified within the first 45 days of the transaction. So day zero close, day 145 begins to run, identify by day 45, another 135 days in which to close, so you're done by day 180. But generally speaking, no extensions for these deadlines. So even if it's on a Saturday or Sunday or a legal holiday, you have to comply with the actual day. There's some rhetoric out there that suggests that maybe that will be changed to give you to next business day, but nothing's been really codified at this point to confirm that. So we still go off the actual reading of the reg, which says no extensions. You comply on the day of compliance regardless. And then the last thing you see here, you've got to close by, there is one little kind of quirky exception, and we deal with it at the end of the year. If you sell something after about October 15th or 16th of a tax year, you really only have until the earlier of 180 days or your tax filing deadline, whichever comes sooner. And so we have to start to pay attention to that because oftentimes people will think they have 180 days to complete something when they really don't unless they file an extension on their tax return. It becomes really problematic in December, for example. Someone starts a transaction in December, they go, oh, I have 6 months from December to finish this thing. When if they're an individual, for example, they really only have until April 15th unless they file an extension. But there is that ability to do that extension, which gives you the benefit of the whole 180 days. So I mentioned the 45-day. So that's probably the most important thing that can be scrutinized if one were audited by the IRS and saw, the IRS saw that there was an exchange and wanted to look at it, is did you identify timely and properly? Everybody agrees that 45 days is a pretty onerous time constraint, but it's in the code. There's nothing we can do about it. And so you have to comply. And if you've been in the business long enough like me, you understand and realize that this is the rule that people hate the most. And this is the one that they would like to manipulate the most given the opportunity. And for me, it's the one that you should follow exclusively and to the letter, because this is the one that whenever anybody I've helped with a transaction says were audited, this is the first thing IRS asks them. And so again, you have this 45-day window to ID. And when you do identify, it has to be in writing. It's got to be signed by the taxpayer. It's got to be delivered to someone like myself by day 45. And you've got to specifically identify what it is you're going to acquire. So you couldn't say, for example, I'm going to buy a condo in Charlottesville. That's not specific enough. You would need to give a street address, a unit address, etc. You want to be very unambiguous in your description. And then you need to choose a rule. that you're going to utilize. And so in our process, there are three. The last one you see there, 95% rule, we typically kind of ignore that because no one really uses it. I've had it used on me a couple of times. I've been doing this about 30 years at this point. I've had the rule used on me twice. And the reason nobody uses it is because it basically says you can identify whatever you want for whatever value. But if you want to get deferral, you've got to buy 95% of what you identified in order to successfully complete your exchange. So my example would be I sell something for $1 million and I identify something worth 10 million. If I'm trying to use this 95% rule, then I have to buy $9.5 million worth of real estate. And that might be difficult with $1 million in my pocket. So most of the time, people are using either the 3-property rule or the 200% rule. What I find is most people use the 3-property rule when they're going to buy a single replacement property that's going to be equal to or greater than the value of the property they sold. So what they'll do is they'll identify property A as their first choice, and then they'll use B and C as fallbacks in case something happens to A. Reason being is that once the 45-day window expires, you cannot go back and change or add to or do anything to affect that identification form. You're locked in after midnight of the 45th day of what you've identified for acquisition purposes. And then the next most popular one, the 200% rule, that's usually used when someone's trying to diversify their portfolio. And what I mean by that is they sell an asset for $1 million, let's say, and they want to buy 2 or 3 or 4 pieces that are worth less. And so they'll use this 200% rule because they can identify more than 3 properties like they could under the 3-property rule. And so example would be I sell for $1 million. The 200% rule really just means 2 times. So I take my $1 million, I multiply that by 2, that gives me 2 million. And then I can identify as many pieces as I want, so long as the aggregate value of those pieces when added together does not exceed more than 2 times my sale price or 200%. In my example, 2 million. So let's say I own a piece of property that's worth $1 million. What I'd really like to do is end up with 4 pieces that are worth $250 a piece. And the 200% rule would allow me to identify up to 8 pieces worth $250,000 a piece. As long as I get 4 of them to get me to my $1 million, I'm good. So that's why we kind of look at the rules, and they really get used depending on what the outcome is, the desired outcome for the client is in the way of what they're getting in replacement property. So I mentioned a couple things in there, equal or greater in value, why you might choose the 3-property rule. So in order to get a fully tax deferred transaction, there's a couple of prongs that need to be addressed. I call it it's a 3 checkpoint rule. It shows here is kind of 2, but it's really 3. In order to get 100% deferral, you need to go equal or greater in value of what you sold. And what we mean in value is greater than the net sales price, because you do get to reduce your sales price by ordinary and customary closing costs. So example, I sell for $1 million and I end up with 950,000 because I paid 50,000 in closing costs. 950 is going to be my target. So I want to make sure I go equal or greater in value. I want to make sure I spend all the cash that I receive at closing. And if there's any debt against the property, I also need to replace that debt. With debt, I have a choice. I can either get new debt of equal or greater amount, or I can put my own cash into the deal to make myself whole. So a visual of that is what's on this slide. So let's say I sell something that's worth 300,000. It's got a mortgage against it of 100. That means I have 200,000 of equity at close. And again, I'm using round numbers and ignoring closing costs. So when I look at my value proposition, I say, okay, I'm going to go buy a replacement property. And here I say, I'm going to buy something for 300. Okay, so I check my first box, equal or greater in value. I got 200,000 of cash at close, but I only spend 150,000 at the closing of the acquisition. I can't check that box, spend my net cash. And even here, even though I went up in loan amount, to get me to my $300,000 need, that's still going to create what we call a cash boot or partially taxable situation, because I didn't check all my 3 boxes. I didn't go equal or greater in value. I didn't go equal or greater in debt. And I didn't spend my net proceeds. So we have to be conscious of all of these numbers. I can tell you people get very aggravated on the debt component because they don't understand why they have to replace it. But the IRS basically takes the position that you have a choice. You can sell and pay us tax, or you can do a 1031 exchange and defer the tax. But if you're going to do that, we want you to move everything forward. That includes cash and debt. And so we do have to address this debt component. So here, what we would have is $50,000 of $50,000 of the transaction would be partially taxable. You get deferral on the difference, whatever that might be, but you would have some recognition because you did not spend all the cash. Another visual here: sell for 300, have a loan for 100. I get 200,000 at close. I decided to go up in value, so I'm gonna buy something for 400. Equal or greater value box checked. I got 200,000 of cash at close. I spent it. 200,000 equal or greater, spend my money, check. And because I'm going up in value, I'm going to go ahead and increase my debt loan. Fine. The IRS doesn't care if you borrow more money. They just want to make sure you spend all your cash and replace your value. So here, this would be 100% tax deferred transaction. I mentioned previously, some things that don't qualify for like-kind stocks, bonds, etc. And then we have to be really conscious about who is doing the transaction. So generally speaking, whoever sells a piece of investment real estate or trade or business use property, that person or entity has to acquire. I'm going to jump to the next slide and then come back to this one real quick. So you see here, if a partnership sells something, the partnership needs to buy something. If a corporation sells it, the corporation needs to buy it. You see here, a trust sells, an individual sells. There's a couple of variations. I'm going to go back to the previous slide to define those in more detail. And then I can always sell something that I own 100% of. So let's say I own a small single family residence that's worth 300,000. I'm the sole owner, but I want to go buy something with some buddies that's worth, 8 or 9 or $1 million. It's okay if I sell my 100% interest in my $300,000 piece and end up with a tenant in common interest or undivided interest in a much larger asset. That's okay for 1031 purposes. So you see on this slide, I'm sorry for jumping back and forth, trust sells, Rick and Sue buys individuals, Mary Jones sells, a sole member of an LLC buys. There are a couple of exceptions when we talk about same taxpayer requirement in 1031, which are beneficial to customers from a planning perspective. So I have a choice. I can buy as John King, or I can buy in a single member LLC of which I am the sole member, and it's disregarded for tax purposes. The benefit of that is if I do that option, I get the protection from creditors of owning my asset in an entity, but it's disregarded for tax purposes, so I'm still only filing one tax return. So that's an advantage that is provided in the process, which you can avail yourselves of, which works out great. And it's the same for entities. If the entity sells, it can create a new single member LLC of which the entity is the sole member and do the same thing. I have lots of customers, both individuals and entities, that like to own their assets in separate entities all the time. Just helps prevent creditors from coming after their personal assets or other assets that they might own. And so the use of this single member LLCs is very productive. And then if you have a loan involved in a transaction, oftentimes lenders do not want to lend to revocable trusts. So the IRS recognizes that's a limitation. And so they say, if you have a grantor trust, revocable trust, living trust, that currently holds title to your property and you're selling it and want to do an exchange and the bank says you have to buy it in your own name, that's okay. And then you can either contribute it back to the trust post-exchange or not. That's entirely up to you. And then unfortunately, it comes up from time to time, start an exchange and we'll have a taxpayer that passes away during the process. It's okay if the estate goes ahead and finish the transaction. That's a benefit to the heirs because if the exchange has taken place, person is recognized as being deceased, and now the asset's being passed as part of the estate, those heirs get a stepped up basis, which means they can turn around the next day and sell the asset for whatever it's worth, and they don't have to pay any tax. So that's a good thing. Now, one of the things that comes up a lot, and I take some time to talk about it, is I often come across situations where it is a partnership that owns the investment real estate. And for whatever reason, the partners have decided they don't want to be together any longer. And so you cannot sell a partnership interest, meaning the stake you own in the entity, because that's not real estate. What's real estate is what's owned by the entity. And so what we end up trying to do is figure out how can partners move forward without each other and still satisfy the requirements of Section 1031. So in our world, we have a couple of methodologies that are used. One's called a drop and swap, meaning the partnership will drop down a tenant in common or undivided interest in the actual real estate asset to the individual partners. So now they own an interest in real estate and not an interest in an entity, which allows them to do 1031 exchange. We can do it beforehand, we can do it after. There's a bunch of ways for us to get from point A to point B. And then also, you could perhaps dissolve the partnership ahead of time. So now the individuals own it instead of the partnership. So there's some mechanical ways to do it. What I encourage people to do is if this is their situation, we need to talk about it sooner than later because there's a couple of different approaches to the process. Some still consider a rigid approach the way to go, meaning we've got to look at some timing and holding issues. There's another group that says, this is a business reason for doing something, so let's not be so concerned about some of these other issues we normally might be concerned about. So I think we just need to have a good discussion about how partnerships that have partners with differing opinions of how to move forward can do so on a tax-deferred basis using Section 1031 to their advantage. So again, if you have any inclination that this is going to come up for yourself or a customer, they need to talk to someone like me that can recognize the issue, help explain to them choices so they can make an informed decision how to move forward. Another common one I'm going to bring up, even though we don't have time to speak of it in great detail, but I have been getting lots of calls about this lately for some reason, and I don't know why, other than everybody's using the great research facility Google to figure out how to do 1031. And one of the things that comes up is reverse exchanges. And so all of reverse exchange it's a tool that allows the client to purchase first and then sell later. If you look at the second bullet point, says we take title to property. So they're referred to as reverse exchanges and all the materials that exist in the marketplace. But what it really is what I would call a parking arrangement, meaning as a taxpayer, you can't own both properties at the same time and call it an exchange. So what's been created is this methodology to allow to buy first and sell later, but it's really a parking arrangement. So you have to do two things at once. You have to have your normal exchange going on where you're using a qualified intermediary to sell something and then buy something. And then you also have this secondary process, which is called an exchange accommodation title holder process, which allows the exchange accommodation title holder, or EAT is the acronym we use, to acquire something and have it available so that when you do sell the property you want to get rid of, the target piece is ready for acquisition to complete your exchange. So some of the advantages to it are, what you want to end up with is tied up because you've arranged for an exchange accommodation title holder to buy it and hold on to it. Then you're not necessarily worried about the time constraint of 45 days of figuring out what you're going to end up with because you already know it's already held by somebody that's just holding it for you. Some of the drawbacks, though, are you haven't sold anything, so you don't have any money, proceeds. So you have to come up with a methodology to provide funds to the exchange accommodation title holder to actually acquire the to be parked or target property. If you don't have the cash and you're relying on financing, that can be a problem because most conventional lenders do not lend to LLCs because Fannie and Freddie won't buy those kinds of loans. So if you're going to be borrowing money from a third party, it typically forces you to get a hard money loan or go to a commercial lender or go to your local bank, who's going to be willing to service the loan for some period of time so that it can be made to the exchange accommodation title holder entity. And that presumes the bank is on board because now what we're really doing is the bank is relying on their customer, the taxpayer, to qualify for the loan. And they're expecting to be able to encumber the property with a mortgage and the like. And so what we have to do and go to the bank is tell them, look, yes, the customer's the one's qualifying, but you're actually making a loan to this exchange accommodation title holder entity that's does not have the borrower as a member of the entity. And then we want that loan to be non-recourse to that parking entity, exchange accommodation title holder. So it's a little different than what they're used to. If we're given an opportunity to explain what we're really doing and explain to them also how they can perhaps get a personal guarantee from the client or the like to make themselves more secure, then typically if the lender's open to that conversation, we can get somebody on board if we have to borrow money. And there are additional costs. So in a normal exchange, when you're selling something and buying something, what the qualified intermediary is doing is creating documentation and telling people what to do, but we're not actually ever in the chain of title. We're just managing the process. When you do this parking arrangement, you are asking somebody to buy something for you. So now they're in the chain of title. And so in our example, when we are in the chain of title or acting as an EAT, our costs go up significantly because we know now that if we're in the chain of title and there's ever any litigation, we're going to have to pay to get out of the litigation. So we charge accordingly. And so depending on the property type and the value, that parking fee can begin to get expensive. And so that's something that needs to be talked about up front as well if somebody's really contemplating doing a reverse exchange. How do they come up? A couple of reasons. One would be customer finds exactly what they want and they just haven't sold anything yet and they don't want to wait. They want to take it down. And that's okay as long as we can make the finances work. Another way that it works sometimes is that the customer will have sold something and went ahead and put their target piece under property and have a closing date, and they didn't make the transaction contingent. Now something happens with their sale property and they're forced into this reverse situation. And so, again, from a planning perspective and, thinking about the additional costs and the like, if we can have that conversation up front, it's going to be helpful for everybody. And then one of the other things that comes up quite often in my world is anything that is deemed commercial by my underwriting department, which in my underwriting department, that means anything that is something other than a 1 to 4 unit residential property is going to be considered commercial. So raw land even is going to be considered commercial. And so we are not allowed to take title to something that's commercial in nature without a clean phase 1 environmental report. And I come across many situations where customers are not intending to get a phase 1 for whatever reason. And so that puts me in a predicament where I can't help them. I think most qualified intermediaries are the same. And the reason we're so concerned about it is that uh, environmental has strict liability that runs with the land. So anytime you're ever in the chain of title on a piece of property that ends up having an environmental issue, you are going to be economically responsible. And so since we're a subsidiary of a large publicly traded entity, quote unquote, a deep pocket, we don't want to be put in a situation where now we're going to be paying out on something that we simply took title to as an accommodation. So it's something we pay very much attention to, and it can create situations where I can't help clients because I can't take title to something without a clean phase one. And then kind of another variation of this parking arrangement, which is been very popular lately too, I think, for various reasons, is what we call a build to suit or improvement exchange. And we can do it backwards, where we could take down the target piece ahead of time and begin to make improvements to it. And that gives our customer 180 days to get what they want to get sold, gone. Or we can do it as what we call a forward improvement process, where we've sold something. So there's a big pool of funds laying around in the exchange account, and then we can use it to make improvements. This is similar to the reverse situation in the sense of, again, you can't own both pieces at the same time and call it an exchange. So you've got to use this parking method to allow for the to be improved piece to be taken down while it's owned by this exchange accommodation title holder, EAT entity, just like in the reverse. The EAT can use money from the exchange account to make improvements. And the goal is to get to our exchange requirement, equal, greater in value, spend all of our cash, replace any of our debt by including improvements in the process that we can get done by 180 days. So a couple of, the benefits are the same as the reverse. You get to end up with something exactly like that you wanted without having to wait and worry about, finding, etc. But 180 days is a very short period of time to make improvements. So typically, my experience has been, if someone is selling something for $500,000 and wants to end up with something that's going to be worth $500,000 after they improve it, that's going to be tough to do in 180 days, because presumably, example, sell for 500, buy a piece of dirt for 100. We got to get 400,000 of improvements out of the ground in 180 days, depending on where it's located geographically, how busy the marketplace is at the time, availability of construction materials, etc. 180 days goes quick. Where we have much more flexibility, I think, and much more success is if you're going up in value. So again, my example, sell for 500, but I want to end up with something that's worth $1 million at the end of the day. So let's say I find a lot that's worth 300. So I've sold for 5. I've bound this lot for 300, which means I only got to get 200,000 out of the ground by day 180 to get me to my $500,000 need. So if we're in situations like that, this improvement process is really good. Again, it's more expensive, but sometimes it's exactly what somebody wants because they can get exactly what they need as replacement property. And so I know I've spoke very quickly and covered a lot of topics this morning. And I hope you got some positive material from our discussion, but certainly I am happy to take questions now if you would like, or you can send me. Sorry, I'm clicking through and having a hard time talking and doing it at the same time, but you can ask questions now. We can have you email me questions. You can call me with questions. Anything you need, I am happy to help with, and anybody in our group is happy to help with. And any topic we discussed this morning, plus many, many, many others, we have available in single standing PDF form, which we can share with you, and then you're welcome to share it with whoever you want. So with that said, I'll stop now. And if we have any questions, I'm happy to take them. And if not, again, you can follow up. I'm going to look. I see there's a chat here. Let me see if I see anything in
Yes,
here.
it does look like we have some questions in the chat.
Yeah, so I see here, what are typical costs? I would say the costs are pretty close across the country in a standard exchange. So, for example, me, if you called me today and it's a transaction under $3 million, typically speaking, I'm charging a flat fee of $1,250 for that transaction, which covers the documentation for your sale as well as the documentation for your purchase. One thing I did not touch on is that the qualified intermediary business is unregulated. Most people are not aware of that. And so if you remember from one of my slides, I said, you're giving me your money, which oftentimes is a significant amount. And so unless I'm offering up any kind of protection, that money's 100% at risk. So in my world, and it's true of most large qualified intermediaries, because we're all owned by publicly traded entities, included in my basic fee is also errors and omission coverage and fidelity insurance coverage. And the minimums we provide for every transaction is 10 million in E&O and 20 million in fidelity. So unless you're above those thresholds doing business with me, you're covered by our basic coverages. So you've not only got the bankruptcy remoteness protection, you've got the errors and omission in case we do something wrong, you've got the fidelity in case we do something criminal, and then you've got this large publicly traded entity that's standing behind us. And that the costs are pretty much the same. What I will tell you is if you search hard enough on the internet, you'll find somebody that says they'll do it for $400 or somebody that says it will do it for $500. I will tell you that those people are offering nothing in the way of protection for you or your customer. And then a lot of them are just new to the industry because they see that, you know, this is a great way to generate revenue if you do enough volume. And they'll jump in and open up a qualified intermediary because they can. That doesn't mean they know what they're doing. And it doesn't mean there's any kind of assurance that they're going to continue to be in business and or be able to cover an incident if something were to happen. So my suggestion is when you're shopping QIs, the ones that are the most reputable and have been around the longest are all owned by large title insurance companies, just like my group is. And those are typically the players that, if you want to be sure nothing's going to go wrong, those are the players to talk to. In the world of inventory being low in certain price points, is it common for the 45-day period to identify a new property to expire? It can happen. My suggestion always to customers is, as soon as you know you're going to sell something, start looking for what you want to replace it with. There's nothing in the rules that stops you from identifying potential replacement property beforehand. There's nothing that prevents you from putting it under contract and making deposits beforehand. What we want to do is just focus on the timing. We want to make sure you close on your sale before you close on your purchase so that you don't have to go the reverse process and have a much more expensive transaction. So do that, and then make your sale or make your purchase contingent on your sale. And that will give you the luxury of avoiding some of the headache that can be caused by that 45-day period. Start early and just make it contingent. That generally works to assist in avoiding the headache. One of the things too, I know contingency sometimes can be a problem, is, and I've been around the real estate business a long time. My wife's a broker, so I'm used to dealing with this issue, and it's always the same. A buyer of real estate wants to put as little money down as a deposit and get as much time as they can get to close, right? And so as a seller, that's not very helpful. So one of the things I suggest to my customers when they're thinking of trying to get a seller to cooperate with them, to give them more time, let's say, is offer to put up a substantial earnest money deposit rather than just the nominal couple thousand that you normally want to. And even go so far as to say, look, here's a substantial deposit. I need this number of days to close because I'm trying to get my other piece wrapped up. If we get to that day and I need a little more time, I'll even go so far as to say I'll release some or all of my deposit to you to get an extension on the closing window. so that I can, again, stay as a forward exchange. And I find that unless the seller is desperate for cash themselves, they're willing to cooperate and be more helpful when they know you have skin in the game. And they know you're not asking for time just because you can. So I offer that up a lot. And another one, especially if it's a rental property that the seller is getting rid of, is maybe do a lease option. So they're still making money on the deal and you've tied it up, and hopefully you get your place sold quickly and you can exercise that option and be done. So there's a couple workarounds that you could probably use.
Awesome.
Here's another one. Say
Oh,
client paid 250, 200. Oh, sorry. Go ahead.
that is all the time,
Oh, you want
unfortunately,
me?
we have for questions today.
Okay.
But if anyone has any additional questions, feel free to reach out to John. Personally, he would be happy to answer them. Thank you, John. We really appreciate your expertise and everything you've taught us today. That was great. Before we end today's event, I would like to introduce Megan Rogers from Farm Credit of the Virginias. She would like to say something. And then please make sure you donate. Kelly put the link in the chat box, so she should be adding it again, but please make sure you donate.
Yeah, thank you. I'm Megan with Farm Credit. Thanks for giving me a second to talk. And I learned so much during this. I know Farm Credit has financed some 1031 exchanges. I've never done one of the reverses, but we are one of those local lenders who doesn't sell the servicing. So it sounds like something that we would do in the right situation. But Farm Credit specializes in financing for land, farms, any type of agricultural business or agritourism, unique rural dwellings. We can do a lot of the more unique properties that maybe traditional financing wouldn't cover. So thank you again for having me today.
Awesome. Well, thank you so much. If you are a Facebook user, please consider joining the Charlottesville YPN Facebook group for continued networking and YPN information. I hope everyone has a great day, and thank you again for joining us. We really appreciate it.